On the global ag trade, brick by brick, we are going to discuss the relationship between the United States and China, and yet a lot of what's going on in the fields in Brazil and the United States. Right here on Connected Farmer, your channel to keep you up to date with the latest trends in agriculture and livestock. Mike, it's good to see you again here on this session, Global Ag Trade, brick by brick. And let's start right on with the geopolitics and macroeconomics that we like so much to talk about. So, after Trump said that China has breached the some of the agreements with the United States, there was a formal invitation to the leader of China, Xi Jinping, to meet with Donald Trump. And yet we also have the news related to that many Chinese students could have their visa revoked in the United States.
Yeah, that's a great way to lay it out, Louise. And we're getting this information daily now and sometimes several times a day. And we've noticed a reaction in the soybean complex. But Secretary of Treasury Bessent was in Switzerland on Tuesday. He brought up the idea that China has one of two ways to go. Either they can become a responsible partner in the international order, and these are my words paraphrasing what he said, or they can go the other route, and we don't have much of a relationship between the two countries. And he did not talk about whether President Xi and President Trump would be talking about trade later this week. The White House press secretary, did say that they were planning on a conversation later this week in her press conference about the same time the Secretary of Treasury was talking. And so I think the way I'd lay out this situation in the markets right now and then get a little bit deeper on the geopolitics is soybeans are finding some support because we're not getting any bigger South American production numbers from private sources, not like we are in the corn. And so that's giving the beans a bit of a lift. The other bigger piece of the puzzle is the soybeans are finding a lot of support off this potential breaking of the ice or thawing of the ice in the U.S. China trade relationship. But I'm kind of taking it the other way. This to me is kind of the end of the road as far as us getting something matched up between us and China, especially given, and this is really an important piece of the puzzle, I think that the trade hasn't really thought about much, the steel tariffs that President Trump increased on Friday night from 25% to 50%. Those go into effect on Wednesday of this week, and it's across the board tariffs. And the European Union and China are already upset about that. And I think between that and the consistency of President Trump's people and him himself saying that we want to bring manufacturing back here to the United States. President Trump said it again on Tuesday about steel, about shipbuilding. Why would we want to give our strategic competitors the ability to build our ships for our military? And I think we continue in the trade to underestimate the seriousness and the desire of the policy of President Trump and the Trump administration wanting to bring manufacturing back here to the United States. And they're not going to deviate from that. They can soften it if they get what they want on the tariff front, but they're still going to bring manufacturing back here. And so China really, in my opinion, and a lot of Asia, in my opinion, really have to decide whether they want to play ball with the United States or have all of the Asian countries come together. And that's being discussed right now at some pretty big meetings, like the ASEAN meeting that just concluded last week. The former prime minister of Malaysia just came out on Tuesday and said, let's kind of forget about the United States. Let's work more with China, and then let's develop India as an Asian bloc. And Russia is still banging the drum of doing a BRICS grain exchange, essentially trying to lock out the Chicago Mercantile Exchange in the United States. So while we might get some good news here, and I hope we do, I think the path of least resistance is still a problem in this trade relationship that it can't really be solved at this stage between the United States and China, and maybe to a lesser degree, the the United States and Europe. So I'm still on track for the beans falling similarly like they did in 2018, and they've lost about 30 to 40 cents since the early part of last week when we closed before the holiday, the Memorial Day holiday. We're still very much on pace with 2018 in soybeans. And I hope I'm wrong, but I've had to tell that to clients that we are looking like we could drop potentially $1 to $1.50 like we did in 2018 because of big Brazilian supplies and the possibility that China may not buy much from us.
And you think that the less industrialized countries in Asia have more potential of cutting a deal with the US?
The South Korean election was just won by a more left leaning leader, and the opposition party won in South Korea. And so we have to develop a brand new trade relationship and political relationship with the South Korean leader, since it's not the same one. Japan is not too happy about the steel situation, but I think President Trump did a good job of offering Nippon Steel a very good deal to stay in the United States and keep a good chunk of their market share for our automotive industry. I would be of this opinion, Luis, broad brushing it. We can take on all these small countries. That's great. But what we really need to replace China is a big trade deal with India, because then India won't go shopping around with all the other Asian countries, especially China, and become more loyal to the United States. And we'll have a stronger bilateral relationship with them. Many, as I've said before, that I've talked to in Chicago and in the commodity industry, and I believe this as well to a degree, China, the new China is India. India is the next China as far as the potential new commodity boom, because of the path of their middle class at this point, and their political structure that they're trying to change.
And wow, we have so much to talk about. We still will talk about the weather, but another aspect that I wanted you to weigh in is the energy markets. We have so much going on the energy markets that may impact the grain markets. I think AI is impacting a lot the energy markets at this time. I think that he may be one of the reasons behind OPEC increasing production while the world economy is slowing down. And do you think that that is a major aspect long term?
I think Saudi Arabia, if I had to guess, after President Trump came back from the Middle East and this production increase was moved ahead more rapidly, and it seems to be getting even more rapidly moved ahead as each week goes past here in the last couple of weeks. If I had to guess, I would say all is not well between the Saudi and Russian relationship, and all is not well between the Saudi and Iranian relationship. It's a lot easier to see the conflict between Iran and Saudi Arabia worsening because Iran is getting closer and closer to a nuclear weapon. And that's the last thing the kingdom of Saudi Arabia wants at this point. And so I think that's why they're really teaming up with the AI and with defense. That was just as big a part of what they did with the United States a few weeks ago, as you referenced. But I think the OPEC situation, coupled with the terrible wildfires in Western Canada, Alberta and the Alberta sands are essentially the shale boom, Houston, Texas, essentially, of Canada when it comes to their oil production and their refining capacity too, but especially production. And the market's caught wind of the idea that these wildfires are getting dangerously close to curbing Canadian oil production. So we've had a couple different things come in here and stimulate the short covering in this market, mostly supply driven, not demand driven, because of the fact that we still have geopolitical uncertainty when it comes to Russia and Ukraine and the Middle East, and now this issue with the Canadian production. I think this is where the key to me is last month's high in the WTI crude oil was sitting right around 64.19. That high, if taken out on a weekly close during the month of June, I think that could be classified as a potential breakout to the upside. And I think, bottom lining it out, even with the OECD cutting world growth today, cutting U.S. growth today pretty substantially for 2025. Still think oil is probably undervalued when it comes to what we're dealing with geopolitically, especially if we hear the phrase or the words Iran now has a nuclear weapon or has nuclear grade material to be able to build a weapon.
Okay, now giving a wild turn to weather in Brazil and the United States, the USDA came up with a report today about the crop conditions in the US and giving rating the crop good or excellent by for nearly 70% of both corn and soybean crops. While in Brazil, the harvest is starting for the second corn crop, and CONAB and the local consultancy Ag Rural have like quite similar information that the harvest might be reaching 1%. Are you still a bear for the Brazilian corn crop?
Yeah, USDA has got a record planting, and I'm not going to argue that, but they've also got the third highest yield on record going back to the mid 2010s. And I just feel as though both of those are going to be very difficult given some of the weather features that we've faced over the last 30 to 45 days. And that while harvest, as you say, is starting, that safrinha corn crop, which is about 75% of the total production, goes all the way into September. And so I think a hotter, drier bias that we're looking at in Mato Grosso, center west Brazil, could still trim the crop. And so I'm at a 5.65 tons per hectare number. USDA is at 5.8. That's the difference between a 128 crop that I'm at roughly versus a 131 crop that they're at. What really shook the pillars of this market, in my opinion, Luis, are these private estimates that are going into the 132 and even 134 corn production number that came out late on Monday from a private U.S. analyst. That is a number that the market is not ready for, and you could see that in the spread. The July D's corn spread actually went negative and closed below zero. So we're back to a carrying charge contango market in July D's corn for the first time since October 31st of 2024. I just don't think the demand fundamentals support that. I don't think the northern hemisphere crop conditions in China, in the Black Sea region, even in parts of Europe, and even here in the United States with that 67% good to excellent number that you referenced, it doesn't justify the July giving up the leadership at this stage. Historically, the July D's corn spread is a demand spread, that the demand is outpacing supply. Our exports are still 20 some, I think 25 or 26% year to date ahead of where the numbers were a year ago at this point. Our ethanol numbers, our production numbers are coming back up. U.S. stocks of ethanol are hitting new 2025 lows as of this past week's numbers. And so to me, the July D's corn spread is suggesting a bigger Brazilian corn crop, and I'm just not there yet.
Well, and I think be really quick, I want you to assess the beef situation and its impact on the grain markets. We have the U.S. now restricting some imports, especially from Mexico, due to health concerns. Uh, how do you assess the beef imports in the U.S. and its impact on price and grain prices?
Yeah, I would say that we are trading the screwworm border shutdown in real time, and that the cattle on feed report and the cold storage report and the screwworm fundamental factor feeding the bull, coming in and feeding the bull, is being priced into this market. Just on Tuesday, we made an all-time new record high again in lead month feeders. The August feeders still have to go up to about 307.70, I think it is, to be able to get up to their old highs from May. But on a lead month basis, we've got brand new all-time record highs. We're pricing in this bullish news. So to me, it's a lot simpler market than it was maybe 3 months ago, because I think we're rationing demand pretty quickly, but the supply keeps tightening. And as soon as that border opens up, I think we have to assume that we're going to have to pull that screwworm premium out of the feeder cattle market. And like 2014, once the feeder market topped, the fat cattle were pretty quick to follow within a couple, 3 weeks.
All right. Anything else, Mike?
No, thank you, Luis, and appreciate all your help on the South American weather.
Thank you very much.